On July 16, 2026, the major headline in the market is a sharp technical correction across the semiconductor sector, despite what appeared to be a flawless earnings report from TSMC. Underneath the surface, the initial catalyst didn't come from Silicon Valley, but from Seoul, South Korea, where a regulatory crackdown on leveraged ETFs triggered a deleveraging stampede. South Korean regulators announced a comprehensive package to restrict single-stock leveraged products, hiking minimum margin deposits to 30 million won and banning non-cash collateral. This policy change triggered a massive forced unwinding of leveraged ETFs tied to Samsung Electronics and SK Hynix, culminating in a 6.37% crash in the South Korean Semiconductor Index. This forced selling created immediate negative technical contagion, spilling over into U.S. chip stocks. SK Hynix shares are facing structural pricing anomalies as a result. The SK Hynix ADR trades at a 22% premium to its domestic South Korean shares. This persistent valuation gap is driven entirely by regulatory conversion barriers, rather than fundamental differences, limiting arbitrage and complicating risk management for international tech investors. While South Korea liquidated, TSMC released its second quarter earnings, showing stellar results. Revenue grew 36% year-over-year to over $40 billion, and net profit rose 77% to $22.1 billion. Despite raising its full-year guidance, the stock suffered a sell-the-news reaction, demonstrating how overcrowded the AI hardware trade has become. TSMC's earnings also revealed a significant increase in capital expenditure, with its 2026 Capex budget raised to a range of $60 to $64 billion. Furthermore, TSMC announced a massive $100 billion investment expansion in the United States to build advanced 2-nanometer manufacturing facilities. This highlights that while short-term market pricing is undergoing a technical correction, structural long-term investment in chip fabrication remains extremely aggressive. Beyond the technology sector, macro risks are shifting. Analysis indicates that global energy transit is shifting from the Strait of Hormuz to the Bab el-Mandeb Strait as the primary geopolitical friction point. Following the breakdown of the Houthi-Saudi agreement, recent attacks on Aba Airport signal a collapse in local stability, threatening 6 million barrels of daily crude transit. The actual mechanism closing these maritime straits is not just military action, but the financial reaction. European insurance companies are canceling war risk coverage for vessels transiting the Bab el-Mandeb. Without insurance, shipping companies are forced to reroute around Africa, adding significant transport delays and shipping costs that could feed back into global inflation. Returning to corporate earnings, Netflix is showing signs of transitioning from a high-growth disruptor into a mature, slower-growth utility. Its revenue growth is consistently decelerating, falling from over 17% 4 quarters ago to a projected 11.7% for the third quarter. This shift is leading to multiple compression as investors revalue the stock's future growth path. Netflix's maturation is underscored by its market share performance. Over the past year, Netflix gained only 0.2% of the U.S. streaming market share. By contrast, YouTube gained 1.7%, and Amazon Prime Video gained 0.4%, showing that competition is successfully eroding Netflix's historical dominance. In the broader tech sector, the massive capital requirements for AI hardware are causing collateral damage in software budgets. IBM shares fell 25%, its largest single-day drop, as hyperscalers divert software spending toward AI hardware. IBM pre-announced weak results, citing software contract delays as clients paused negotiations to fund GPU and data center builds. Today's macroeconomic data also added complexity to the market outlook. U.S. June retail sales increased 0.2% month-over-month to $768.6 billion, with core retail excluding gasoline up a strong 0.7%, indicating resilient consumer demand. However, Dallas Fed President Logan warned that a modest rate hike might still be necessary to ensure inflation returns to the 2% target, tempering rate cut optimism. While PayPal executes its AI transition, public markets may be mispricing its assets. Stripe and Advent International reportedly offered $60.50 per share to acquire PayPal. This buyout bid validates that PayPal's underlying assets are undervalued, with investors like Michael Burry arguing PayPal's intrinsic value is between $75 and $115 per share. Finally, excessive capital in private credit is driving systemic risk. Lenders competing for sponsor-backed software LBOs are giving up critical covenants and lending rights, creating significant moral hazard. While the Australian private credit market remains structurally insulated, with 60% asset-backed books, the U.S. direct lending market is highly exposed if software valuations continue to face downward pressure.